Welcome back. We're joined by our featured guest of the morning now. He's Paul Harris of Harris Douglas Asset Management for more on our top line story and his thoughts on the broader markets. Thanks for coming in.
My pleasure.
What's your reaction to this OPEC news? Saudi Arabia trying to send the signal that it's serious about supporting the oil price and in fact driving it higher.
Yeah, I mean, they've done this before too, right? So, and the price continues to fall. So, I'm not saying that it's an important for them. They need a certain level of pricing, and I think that that's what they're doing. But it's interesting that they're just the only ones really kind of making that decision to cut their inventory, cut barrels, right? Whereas opposed to usually it's a concerted effort to do all this stuff. So I think that says that it's really not something that everybody wants to do, and which makes it seem to me that the price stability that they're hoping for won't last very long. I mean, I think if it was a concerted effort for everybody to cut production and cut by a reasonable amount, it would have been better. But I think they're facing this kind of very difficult environment with the interest rate environment and maybe a slower growth environment, but cutting, last time they cut this, the price jumped, 4% or something like that, and then fell, and it continues to fall, right? So I think that the issue is, the interesting part is that nobody else wanted to do anything. Whereas opposed to us. So that's the most interesting part about it to me, I think, which says something about where OPEC stands on this issue.
Yeah,
right?
It's notable that Saudi Arabia, which is, of course, the key producer, but very much seems to be going alone here. What's your view of the Canadian energy stocks, which have been a big disappointment this year because crude oil prices haven't taken off the way they had predicted to do?
Right. So I mean, I think that, does oil go away, which is a very no, and oil is a use for a lot of things that will continue, and the molecule, certainly from a chemical perspective, will be important. I think a lot of these oil companies have done exactly what they said they were going to do. They're buying back their shares. They're reducing capex. They're increasing their dividend, and so I think that they will continue to do that. But at some point in time, you have to increase production, or else that's your job. That's your business, right? So I do think that in this environment, they're certainly not expensive when you look at any kind of fundamental basis, right? So I think that they're cheap stocks to own right now. I think they face this uphill battle with ESG, which I think is a very difficult thing. But I think Canadian oil companies are doing a lot to change that. So I think you can own them here. You're going to get an increasing dividend. The shares are going to be bought back. I don't think there's anything, do you want to be in oil relative to maybe banks or something like that? I would argue probably be in banks. But I think they're not expensive here.
What is your view then of the broader markets? The debt ceiling is now in the rear view mirror. The market's back to obsessing about the Fed and what it does on June the 14th.
Yeah, so the stock markets, continues to seem to go up. They faced this debt ceiling issue. They were facing credit crunch, bank stocks in the United States and Europe having a difficult time, many, war, oil prices, all these things. So it continues to rise with that. And obviously people make the comment that it's only a few stocks that are going up, and that's fair enough. But it continues to go up. I think the two issues that the market faces is this issue of inflation and interest rates, right? And I think they're the two big things that the market is uncomfortable about. And I think that whether rates are going to continue to go up or whether inflation will come down. I think inflation is not coming down as fast as central banks would like. And I think I would argue that they should probably increase rates, continue to increase rates another 50 to 75 basis points and crush inflation. That may slow the economy even further, and it may cause a mild recession, I think. But I think that's far more important because, as we constantly talk about in the world about this kind of social divide between wealthy and poor. But the fact is that if you are in the lower economic level, inflation hurts you a lot more than hurts somebody who's wealthy, just as you're spending a lot more money on food, et cetera. So we need to bring down inflation to a level that's much more reasonable, right? And so I think that I would rather see them do that and the economy take some pain than to have an inflation problem that continues over the next several years, right? So, but I would say that one of the things, if they decide not to do that, one of the things that they are probably going to do is they're certainly not bringing down rates as quickly as people think. I think the market originally said there'd be a rate cut this year.
Right.
I don't see that happening at all. I think if they want to continue to fight inflation by not increasing rates, they're going to have to keep rates at these levels into next year probably, right? So rates will stay higher, right? That's the part of the problem with that.
Whether central banks in Canada and the U.S. hike rates again this month or next, rates are expected to stay higher for longer as they try to bring down inflation to the central bank's 2% target. This could weigh on equities in the long run. Could fixed income find its footing after faltering in a low-rate environment for the past several years? Well, our next guest says the outlook this year looks quite positive. We're joined by Mark Wisniewski, partner and senior portfolio manager at 9 Point Partners. Mark, thanks so much for coming in.
Thanks for having me on.
So what are some of the, driving forces when we're thinking about fixed income investing right now?
Yeah. So I think it's probably one of the best opportunities we've seen in over 10 years, and primarily for a couple of reasons. The pandemic created, inflation, obviously, as everybody knows, and created some pretty dramatic work by central banks. So we've had an immense amount of rate increases. So base government rates have come up considerably. So if you think about it, was 18 rate increases by Canada last year, more than that in the U.S. So base government rates are really, really high now. So the question is, what happens from here? And I agree with you. It's probably the same for longer. I don't think that we're going to see anywhere near what we have in the past. But it's entirely possible. I know you're going to ask about the Bank of Canada. I think it's a 50-50 split on whether they go tomorrow. But I think for sure they go in July, or they talk very, very hawkishly about what they're going to do. But the fact is, we could get 1 or 2 rate increases in Canada. We're not getting 18. So the damage to all assets, like last year, fixed income, equities, et cetera, has pretty well been done. Because you're starting now with a bond yield and a portfolio yield, which is a multiple of what it was before the pandemic. So we say in fixed income, the first line of defense is income. So in our funds, and at 9 Point, we're an alternative asset manager. What alternative means in fixed income is basically you're active. So in our portfolios, we have a range of anywhere from 7 to 10% yield in our portfolios now. So even if you get 2 or 3 rate bumps next year, or this year, it's not really going to make a big difference in pairing it. It's not like last year when you started with a portfolio yield of 2 or 3%,
right,
and you had 18 rate hikes.
Yeah, it's not eating into that potentially in a huge way where you would be regretting that choice potentially. So when you're thinking about potential challenges to this, I mean, what if there's a recession and it hits really hard and central banks cut interest rates? I know that that's not being priced in the next month, year even, but how does that play out? Yeah,
I don't think they're cutting rates at all this year. And I agree with what you said initially. We're going to be higher for longer. So the biggest opportunity we see out there right now is corporate credit. So it's the same type of things that people buy in equities, like the major banks, the pipes, telcos, et cetera. The yield on those is considerable now. Like it's very, very high. Like you can get, without taking a lot of risk, you can get anywhere from 5, to 7, 8%. But here's the other interesting thing. As a bond guy, we don't like to lend long unless we're really, really compensated for it. Lend out to 30 years or something like that. And because of what's going on now with central banks being as aggressive they are, the yield curve's inverted. So now you can buy short-term credit, i.e. I can lend to a company for less and get paid more. So that's the other gift that the market is giving us right now. So you basically can buy credit and you can buy basically anywhere under 5 years and get paid more than you do in the longer end. So to me, that's a no-brainer. You buy, blue chip Canadian names in short term, and you get paid, anywhere from, as I said, 5 to 7.5%, which is we haven't seen in ages. The last thing that is very, very interesting, and we call it a gift, is that we've never come out of an environment where rates have been as low as they have and has gone as high as they have. So consequently, a lot of the bond universe is now trading at a discount price. So they're government of Canada bonds now that are trading in the 80s. I mean that's like high yield. So when you think about it, well, not when you think about it, the reality of it is at some point when these bonds go from $80, $90 back up to par, a lot of your return will come in the form of capital gains as opposed to income. So there's some tax efficiency in portfolios. So as I said, we're an active manager. So what we're doing is we're selling bonds that are at a premium or at par and buying bonds that are at a discount to create tax efficiency in the fund. So when people say to me, we're looking at GICs, I always say, well...
Right, and people are a lot these days.
So and GICs are great if you're comparing GICs to a basic fund. But if you're comparing it to an alternative or somebody like us who's more involved in credit, you're basically, depending on the fund you get, you're going to get double the yield you do get on a GIC. You get that tax efficiency, and you get daily liquidity. And as we know, you buy that GIC, you sell it, you lose that interest. And as soon as you buy that GIC, your client's going to say to you, I want to buy equities. So with a bond fund, you get income, capital gains potential, and you get that daily liquidity. So again, like a lot of things are lining up well.
So if you were a retail investor sitting at home right now and you're thinking about, well, where could there be some opportunities for me right now that would be accessible, something that they could, be exploring, what would you suggest?
Well, we like a name or a sector or all the above.
Yeah, I guess whatever you think.
We think financials are really cheap. I mean, they're the biggest issuers in Canada. Financials look incredibly cheap. There are some interesting names like Ford, SNC Lavalin, Enbridge, which are all interesting. Everything in the corporate spectrum now looks fantastic right now.
Yeah.
So, and just one last point to touch on before I forget. I don't think this is just an opportunity. I think this is a potential to go on for a while. And because I don't think that interest rates are ever going to go back to where they were, primarily because I just don't think inflation is ever, we talk forever about it, but inflation's going back to 2% anytime soon. But the other thing about it is quantitative easing by governments is probably done. I don't know when we're ever going to see that again. And in addition to that, governments have big deficits to finance as a result of pandemic. So there's the potential, the bond market is going to be in control again of pricing where they want to buy all this debt. So you could probably make the case that rates are going to be higher for longer, which as a fixed income investor, that's great. It means that, we can buy things that have great yield and create a great portfolio for a long time. Maybe a little bit more challenging for things like equities, but I'm a bond guy. I'm always going to say that.
Well, I mean, you are a bond guy. You love this stuff. But are you often this enthusiastic about it? Because, like you said off the top, this does seem like it's a particular moment.
Yeah. So to touch on it, I think your last question, a recession is a risk, right? The yield curve is telling that. Central banks are telling us. But what it looks like now is that the chance of recession is becoming, a significant recession is becoming less and less remote. We'll get something, but it probably won't be significant. So with that, when you look at credit, corporate credit's already pricing in a mild recession. If I look at equities, and a lot of people are talking about that, it doesn't really look like it's pricing in a recession. So I think some of that's priced in.
Mark, great to get your thoughts today.
Thank you.
Thanks so much for coming in. That was Mark Wisniewski, partner and senior portfolio manager at 9 Point Partners.
You are watching Morning Markets. Breaking news. About 30 minutes ago, the Bank of Canada surprised the market by increasing its trend-setting interest rate by 25 basis points, taking it to the highest level since 2001, citing several factors. One, growth has been hotter than expected. Inflation picked up for the first time in April in a streak of 11 months where we have seen inflation come down, and a very curt mention about the housing market picking up. Let's bring in Earl Davis, who continues to be on the desk with us, as well as Francis Hordelski. And if you're just joining, the conversation from you, Earl, has been, well, you called it. I'll give you that for more than a year, or for actually exactly a year. Two, you expect this is not the last rate hike that we've seen from the Bank of Canada. And now it comes to the Bank of Canada in a global context. The Fed, there's a lot of questions, again, just like there was here. It was not a question of if, but when. There's an expectation they're going to go in July.
Yes.
Not so much in June. Does what the Bank of Canada did, does what Australia did perhaps change that?
I think 100%. They're getting resilient numbers as well, and I think the RBA, Australia, and Bank of Canada allows them opportunity to have a hike. However, I do think it'll be a hike, and they'll allude to a pause, but a hawkish pause in regards to they're watching the data. And the reason why that is we've seen the different Fed governors' speeches and speak. There's a divergence of views. A lot of them were actually leading the market towards a pause right now. But I think people are seeing that the market's still hot. Let's do one more. And then they'll pause to allow Governor Powell to build consensus if the data continues to be strong to resume.
There's too many Fed governors talking. I'd say that just to begin. But the other thing is, I mentioned earlier, Mr. Macklem doesn't mind surprising. I mean, he's a surprise kind of guy. Jerome Powell does not like to surprise. Now, I know it's a committee, but the market is saying, and I haven't looked this morning, 75-80% of a pause next week. So if they go, that would be a surprise.
It depends what the market's thinking the day before. And the reason why I bet you after today, the chances of a hike have increased significantly in the U.S. I haven't seen the numbers.
It has.
But, yeah.
I don't know about significantly.
Yeah.
It's hard to read through because of how difficult it is to read through the market, but it has nudged up since then. And I guess that begs the question of, it feels like a distant memory, but we just went through kind of an oopsies with the U.S. regional banks. Another rate hike. Things do not feel like they are super stable right now. How much is the Fed thinking about that?
I start from the base case. I don't believe the central bankers, including Macklem, want to hike. In the best case world, they're on pause. Let things wait. The data is not giving them the luxury of pausing. So there's a difference. It impacts people without a doubt, and they don't want to do that. They want to benefit from it. But what happens is if they don't hike, the market gets even more, gets hotter, inflation gets hotter. They're in big trouble then. They'll have to hike more later. It's the same thing.
Are we getting too hot and bothered in Canada about what essentially was a decimal point? Right? That's what inflation ticked up from 4.3% to 4.4%. Oil prices are down. The supply chain constraint index is down. That takes time to work its way through. I look through retail earnings that were coming through. Very few were gangbusters, very few, except for, there were definitely some exceptions, but I would say those were company specific, are enthusiastic about the consumer right now. And what are they going to do when the consumer pulls back? They're going to cut prices to get them in the door.
So let's start with your first thing about being sensitive with the 0.1 increase in inflation. There's a thing in inflation that people look at called the lag effect, the base effect. So inflation was lower at the second half of last year. And if inflation's unchanged for the balance of this year, actually inflation rate will go up because it's a comparison to 1 year before. And given an average of 0.5% inflation, month-on-month inflation, that says we could be at 6% inflation by the end of the year. That's what the base effect
But we have a base effect for May, June, and July, which is very, very favorable.
Yes, June, which is the last favorable one, we get that print in July.
Yeah.
Totally. So I do expect a lower inflation print. But then it goes the opposite way for the balance of the year. The central bank is well aware of that as well, too, and that's what they're trying to get ahead of.
And I guess I know that Amber's looking something up here, but when it comes to that 2% level, we hear it all around the world. Why is that so magic? I sort of remember sometime a while back that there was some fudging from the Fed saying, oh, it's going to be 2 to 3. And where did that number come from?
The reason why it's so important right now, and I believe over time it will change, but it's contractual. The Bank of Canada assigns a contract to the federal government saying we're going to keep inflation for in between 1% and 3% until the year 2026.
It's a long time.
I do believe once that's renewed, that would be renewed at a higher level, which gives the bank more flexibility. But until that point, they have to prove that they're credible in living up to that contract that they have with the federal government, whether they achieve it or not.
Because we're talking about inflation, one of the key parts of the statement that is fundamentally different from what we heard in April, and I'll just refresh everybody's memory. In April, they had a very high degree of confidence that we are going to see inflation fall quickly to around 3% the middle of this year, then decline gradually to 2% by the end of 2024. They said the path from 3 to 2 could be difficult, but very confident. We use that word. Inflation is going to fall quickly to around 3%. That was the last statement. In this June statement, very, very different language that it's easing around 3% this summer. However, they have concerns that CPI inflation could get stuck materially above the 2% target. So a very different view of inflation. They are not at all saying they're optimistic that it could fall down. They kind of touch on it, but that strikes me as quite a language shift, and maybe that's the hawkishness in the statement. I didn't find it in the last paragraph saying the next move needs to be a hike, but that sounds to me the hawkish pivot here.
I agree, and I truly believe that's purely reflective of base effects. In January, we calculate base effects every month. We look at it every week. We calculate every month. In January, we had the same anticipation as the Bank of Canada. Inflation is going to go down until June, but then we were talking about it going up. The central bank wasn't because they wanted to impact inflation expectations. Now we're coming to the end of that runway. It's curious how they mention summer of 2023. They don't mention end of 2023, but they mention end of 2024.
On Bay Street, certainly they like to talk stocks and finance as well, but today there's some fitness and fundraising also at play. The Bay Street Games taking place, an event that raises money to support children's mental health and crowns one firm, Bay Street's fittest. Paige Ellis is live at the event with Helen Hayes, head of iShares Canada. Paige.
Thank you so much, John. So, Helen, you've assembled at BlackRock 2 teams.
We have.
Despite the poor air quality, you guys are here. You're showing out. Why was it so important to come?
Well, kids' mental health is super important. And I think since 2014, Capitalize for Kids went from raising $1 million to $10 million. And in financial services, we want to give back. It's a very important thing. And so we've got 2 teams here today supporting the cause and just being here. We didn't practice at all, Paige, before we joined today. We should have. There's some amazingly fit teams, but we're really pleased to be here.
Great. Well, let's go from fitness to finance. You have 3 different ETF strategies that you think will position investors well for what you're predicting to be a recession this year. The first one is fixed income ETFs. Why do you think it's important to be exposed to fixed income ETF?
Well, Paige, it's really interesting because we have seen a whole evolution, and 2023 is the year to expect the unexpected so far. And fixed income flows, it's been unbelievable, the significant. Fixed income offers equity diversification, allows you to come in and get exposure in fixed income, whether you want to be in Canada or you want to be global. We've seen about 800 million in inflows across our core Canadian aggregate bond index. It's been incredible. And I think what's great is that you can select, again, within your portfolio, having that liquidity, having that transparency, building out equity diversification within a portfolio, whether you're an individual investor, whether you're an advisor looking for fixed income exposure, or you're an institution looking for that liquidity sleeve within your fixed income portfolio.
Okay, next up is internationally exposed ETFs. The world is a big place. Where are you specifically seeing opportunity?
Well, there's 2 main areas. One has been in EMEA. So from a perspective of EMEA, what we've seen, and I think it's because from a US dollar perspective and the fact that really investors have been very overweight North America through the pandemic, that now people are seeing value in Europe, in EMEA, in other parts of the world. And so from a perspective of the iShares EMEA ETF, we've seen a lot of inflow, which is XCF. And we've also seen an XCC, which is emerging markets, some really good flows into that area.
Okay, and finally, you say that dividend-paying ETFs are key. Of course, the growth stocks have been the big outperformers this year. So why do you think it's so critical to have that dividend ETF exposure? Does it just come down to consistent cash flows?
Well, I think there's 2 elements, right? There's protecting the downside within your portfolio. And so something like an XDiv gives you basically high dividend exposure within a portfolio. So you're getting your yield plus you're getting downside protection. And I think it's really in the market volatility that we're seeing, Paige, it's really about creating that downside protection within your portfolio plus that yield.
You mentioned flows into the fixed income ETFs this year. What about overall flows? What kind of trends are you seeing?
Again, fixed income has really led our portfolio for iShares. As I think I mentioned, XBB and our government XGB have been the 2 main iShares where we've seen a lot of flows this year. And again, I think because what's happened from an equity portfolio perspective is fixed income has been an underperformer for many, many years. And for the first time in a decade, you've been able to access fixed income through an ETF. It's very liquid. You can buy it in the morning and sell it in the afternoon, but it gives you that exposure. Where historically you would have had to go out institutionally and deal with a desk to buy your fixed income exposure. So I think now with what we're seeing in yields, with the fact that within the market overall we've had so much volatility, people are looking for that equity diversifier within a sleeve for their portfolio.
Right. Thank you so much, Helen. We appreciate your time today, and best of luck out there.
That, of course, is Helen Hayes. She is head of iShares Canada at BlackRock. Back to you, John.
Paige, thanks very much. An insightful conversation at the Bay Street Games on Bay Street today.
So the labour market in Canada faltered last month, and we saw a jump in, well, a marginal increase in unemployment, the first rise in the jobless rate since last summer. But it's a pretty small loss in the latest month. It doesn't even offset the gains in April. We're joined now by Dominique Lapointe, a global macro strategist at Manulife Investment Management, and Richard Fogler is sticking with us here on the desk on Morning Markets. Dominic, thanks very much indeed for joining us.
Thanks, good morning.
So a small loss, I saw it even described as statistically insignificant, so not a huge crack in the labour market.
Not really, you said it. Compared to the great gains we've had over the past 6 months, it's a small loss. And then actually, when you look at what age group where we saw the job loss, it's mostly within youth people. Notably, StatsCan sometimes has issues with the seasonal adjustment among that group, so it's possible that it adds volatility. And in fact, prime age worker, which makes the bulk of consumption in this country, employment for them rose up a little bit this morning.
You think that more increases from the Bank of Canada are likely?
I think so. After the last inflation report, and this was also confirmed by the last GDP report, we thought that they would go in June. And in their framework, we think that if they decided to pause after pausing for 3 months, that would imply at least 2 more rate hikes. So I don't think this morning's LFS report would change what's going to happen in July. We'd probably need to see way more weakness in other economic indicators before the next meeting for them to change their course.
Richard, we've heard it said that for bank investors, if the employment market weakens, that could be a problem for the banks. I mean, the default rates on loans still pretty low. I presume that's the thing you're watching for.
Yeah, well, there are 2 things. One is a slowdown in the economy in general, which of course may hit rates, and the other thing is increasing rates, which will have an impact on people's ability to handle their mortgages and refinance mortgages. And that's all dependent. But I think the major economic issue at the moment is inflation, not employment. And I think that, because that's going to drive, if inflation doesn't continue to slow down, that will drive rates higher, which will drive the whole mess lower. So I think it's all, you have to take a look at inflation. And what we see in inflation is that it seems to be coming down a lot. If you look at the U.S. numbers, first of all, their last number, ex housing, which is a made up number really, the inflation rate was 3.5%. So that was pretty good. And secondly, goods inflation, which ran the inflation numbers a year ago, they're right back. That inflation rate's come right back down to nothing. It's all service, which means people catching up with the inflation of last year, trying to get price increases, and and it's very hard to get people. Still, notwithstanding the so-called softening in the labor market, now it's very hard to get good people, and it costs a lot. And we see it in our business, we see it in the businesses we talk to, and so that's going to be. I think that's where the stickiness in inflation will be, and we'll see what happens.
Dominic, what is going on with that? These labor shortages? Is it partly because a lot of people have dropped out of the labor market? I know the New Yorker just had a piece about a lot of men quitting the workforce in America.
Yeah, and on that question, I think it's important to make the difference between the U.S. and Canada, because in Canada, the labor force participation rate is actually at a record high, whether you look at men or women or even youth. So it's not the same sort of incentives and big movement that happened in Canada versus the U.S. But you're right, and in the U.S., we've seen people dropping out of the employment pool during the pandemic and not coming back. Sometimes don't want to work at these low qualification jobs that don't necessarily pay well within the dangerous environment of COVID. It's going to go back to school. And at the same time, in the US, the government sent big checks to many Americans, for some, maybe not necessary. So there's also the financial insurance that you can take some time off and redirect yourself towards another industry. And I think that's one reason why in the US we do see a lower participation rate across the board.
It's interesting. I mean, has there been a big, I know it's too early to say, but the Great Resignation, has there been a fundamental shift, either of you, in the labor market?
I'm not sure we do see that in the broad economic data than more than the anecdotes we can read on Bloomberg so far.
What do you think, Richard?
Yeah, I would agree. I mean, we just know it's anecdotally.
Yeah.
So as we talk to companies, and we talk to hundreds of companies a year, both in Canada and the United States, the one thing that seems to be consistent across the board is it is very hard to get skilled workers, and we have to keep paying up for them. So that seems to be where the issue is. So it's not so much in the broad numbers, but in the skilled workers at all these for every different business across multiple industries. It's just it's hard getting good people.
And if I can just add on that, the quit rate measured by the JOLTS in the U.S. actually came down to pre-COVID. So at the peak, maybe you can make a relationship between resigning, but now seems that it's not the case anymore. People are not quitting in masses.
Will the Bank of Canada, they've gone back on the interest rate carousel here, raising borrowing costs. Dominic, will they be very reluctant to get off again? I mean, they don't want to be seen to be flip-flopping too much.
I don't think they want, and we think that if they would have preferred to stay on hold after their pause in January. To be consistent, yes, they're telling us, they're signaling us, and this was even before yesterday's speech by Deputy Governor Baudry and before the hike, that they will be reluctant to cut interest rates. The fear is that, and that's our concern at Manulife, is that we're going to see the global economy slow down, not just in Canada, but Canada will be affected. And this reluctance to actually ease when this would be needed might do more harm than good going into 2024.
Richard, I'm curious, are you a buyer of bonds, fixed income right now? Maybe we could look at a chart for the Canadian 10-year bond yield. Do you think bond yields are going to go up much from here? In other words, bond prices drop?
Yeah, so we're not big investors in the bond market. Our duration is pretty short right now, under 5 years, and the reason is basically the inverted curve, and we think we don't think rates are going to be coming down, so we think the long rate is actually gravitate up to the where the short rates are, because we think this is going to be sort of a norm for the future as opposed to an anomaly.
Dominic, I got to get your take here. Do you think we are seeing asset bubbles right now? Because rates are still historically quite low, but they have been coming up. Is that going to expose people, as I think Warren Buffett said, who aren't wearing bathing suits as the tide goes out?
In terms of bonds, I think we agree with Richard from a tactical basis, but from a strategical perspective, the fact that you mentioned yields are now so high, even if you look at government bonds or corporate bonds, the potential income is quite elevated relative to the depreciation we could see if rates go up a little more in the near future. So we are more positive on bonds, investment grade and government bonds over more on a strategical basis. And in terms of equities, I think we've priced a lot of a recession that still hasn't happened, but we're not back to, in any shape or form, for global equities, some sort of record high level. Valuations are still high, but they're not at the record high. So excluding some stocks, right, and the ones that are probably driving up most of the returns of the S&P 500 right now. So if you exclude those that seem to be more trading on some sort of hype for some new technology, we don't see equities as being in a big bubble right now.
We better jump. Dominic, thank you very much for giving us the time today. Dominic Laplante, a global macro strategist at Manulife Investment Management, and of course Richard Fogler, Chief Investment Officer and Portfolio Manager at King West. Thanks to both of you.